Last week, we spent a lot of time talking about the monetary base, which the Fed controls, which is the funds that are in the reserve accounts plus all the currency. And we talked about how that might be linked to the money supply, which is deposits plus currency. And we never finished. We had enough time to define what the money supply is in the monetary base. And it's clear that, the other thing that we discussed is that the monetary base is entirely determined by the Fed, right? It can change the monetary base at any time by just buying or selling an asset or making loans. The loans are just assets, so it's the same thing. And if it pays for whatever assets it's buying in currency, it's clear how that translates into an increase in the money supply, right? Because $1 in currency here is $1 in currency here. But what we didn't entirely have time to discuss was the connection between the reserve accounts and the deposits. Most notably, reserve accounts aren't part of the money supply, yet somehow they must be linked. So one thing I thought would be good to do today is to discuss the connection between reserve accounts and deposits. That way we'll see how it is that the Fed controls the money supply. One thing we did last time as well was to discuss that the money supply is connected to the monetary base by some multiplier. In other words, just by looking at you may recall, just by looking at any bank's balance sheets, you know that the deposits are much larger than the reserves. So if you add up over them, that's telling you that these funds here have to be less than that, which tells you that the money supply is somehow bigger than the monetary base, and somehow these reserves are blown up to correspond to a larger amount of deposits. That's the multiplier. So our job will also be to try and figure out what's behind this multiplier process, how does it work, and thus what are the factors that affect the multiplier. So the Fed controls the monetary base, but depending on what factors come in here and affect the multiplier, it's not going to have, or it may or may not have, full control over the money supply at the end of the day, which would make its job a lot harder. So that's our job, okay? And to make things easier, remember that the interesting thing that we're trying to figure out is how the Fed takes, how these reserve accounts get blown up into a larger amount of deposits. The currency part isn't very interesting. So to make this easier, so that we can focus on what we're really interested in, let's just ignore the currency. And instead, imagine there's no currency. It isn't hard to do. All that it means if we imagine that there's no currency is that we're saying that all the money is electronic. The stuff that the reserves that the banks pass around each other are electronic, and when we buy something, we pay with deposits by swiping a debit card or a G-World or something. And of course, that is more or less how things work these days, right? I don't remember when was the last time I paid for something with paper money. I'm always swiping a card. So let's imagine that there's no currency, so there's no paper money, all the money is electronic. And in this world, suppose the Fed decides to raise the monetary base. Now, how does the Fed raise the monetary base? Remember, the monetary base is what the Fed uses to pay for stuff. Sometimes it's referred to as M0, actually. So it's what the Fed uses to pay for stuff. And so if the Fed wants to raise the monetary base, it has to pay for something. In other words, it has to buy something. So the way the Fed raises the monetary base is by buying bonds. When the Fed buys or sells bonds, that actually has a name. It's referred to, a fancy name. It's referred to as an open market operation. And if the Fed is buying bonds, then that more specifically is an open market purchase. Just want to put that language on your radars, because when the press or the textbook talk about monetary policy, they may often refer to open market operations, the open market desk, the open market committee. It's all just related to the Fed deciding what assets to buy, what assets to sell, and how much. All right? So that's our job. There's no currency. We want to see when the Fed in this world decides to buy a bunch of bonds, what happens? Great. Specifically, what happens not just to the Fed, but to everyone else? Actually, the Fed is easy. They just bought some bonds. So actually, I can draw this quickly. At the Fed, that's not the right one. Liabilities, assets. They bought some bonds. Let's say they bought $1 million of bonds, and they credit the account of whichever bank or banks they bought the bonds from with an extra $1 million. That part is straightforward. The interesting thing is going to be what happens at the bank that sold these bonds to the Fed. So for that, let's wipe this and start over. So let's think about what's happening on the balance sheet of the bank that sold the Fed the bonds. And I guess the first thing to realize is that you have to think about why the bank would have sold the Fed the bonds in the first place. For this, you should think back to your, I forget what it was called, banking something or other worksheets. Let's see, it's on the exams. Balance sheet practice, that one. Remember the balance sheet practice sheet, where you had banks that were changing different things on their assets. I think the third example was the example of a bank that's lucky enough to have a wealthy, trustworthy GW grad come to them and say, I would like to take out a loan, please. Right? That's the bread and butter business of banks. They make loans to people, charge, interest, and have to make good judgment when they lend. And so the first thing that happens before this bank even gets to sell the bonds to the Fed is that a trustworthy person like you or me came up to the bank and said, I would like a loan. And of course, in the instance in which the bank says, yes, sure, They give us the loan, let's say it's 1 million. And as discussed in the banking balance sheet worksheet, that has to come out of the reserves, right? They have nowhere else. Those are the liquid funds they have to make payments of all kinds. However, before the end of the day, we don't need to see the entire balance sheet to do this. We know that nothing has happened on the deposit side, right? So in this moment that they make the loan, this bank is now below its desired reserve ratio. So they very quickly have to run out and make another adjustment to try and get the reserves. So right now they're one down in reserves. They need to somehow get extra funds. What can they do? As discussed, there are two things that the banks would normally do in this situation. One possibility is that it could borrow from other banks. It might do that. The other possibility is that it might sell some securities. So, and that's of course the relevant case here, because it so happens that it's selling it to the Fed. If I sell one in securities, then I have +1 in reserves. And well, so I was down 1 with reserves, then I'm +1 in reserves, so my reserves are back to where have not changed from the beginning of this whole operation. Notice we're not keeping track of the whole balance sheet, we're just keeping track of changes in the balance sheet. This is called a T account. We're just tracking changes, because we don't care what else is going on the balance sheet. It's just going to clutter this up. Okay, so now the bank is back where it was started with reserves. It's happy, and it topped them up by selling securities. Banks are buying and selling securities to each other all the time, just like they're making loans to each other all the time. But this is different because there is this new $1 million in reserves that were just created. Right? This minus, remember there was a -1 here that referred to the reserves that they were down there, and then they accumulated new $1 million in reserves by selling securities. This -1 here has gone, well, where has it gone? They gave it to me when I borrowed, and so I spent it on something, and so those funds are, well, somewhere else. We'll keep track of them in a second. But this +1 was new reserves that didn't exist before. So overall, we have +1 new extra reserves in the world. So where did the reserves go? I have them briefly because they were lent to me. Of course, when I got those funds, I was borrowing them for a reason, right? Not just to have a loan with $1 million lying around that I'm not doing anything with. I would have probably borrowed them because I wanted to buy something. And let's say I am, again, a wealthy, trustworthy GW grad. And so let's see, what did I want to do with the funds? Let's say I wanted to buy a yacht. Of course, it doesn't really matter what it is that I'm buying, or whether it's one person that borrowed it or 10 people. The point is that they borrowed it to spend it. So now I spend the 1 million on my new yacht. So where are the funds now? Well, now I paid them to whoever it is who sold me the yacht. So remember, there's no currency here. So somewhere else there is a bank which the person who sells boats uses to keep their deposit. It may or may not be the same bank as me, that doesn't matter. That bank suddenly has this extra new million in deposits. And of course, in the instance in which they show up, these are also reserves. So there are the reserves. The Fed created the new reserves by buying securities. This bank, well, they were selling the securities in the first place because they wanted to make a loan. So once it's spent, here is the new monetary base. Here are the new reserves. And also notice, here are some new deposits that didn't exist before that. So this is new money supply. So the bank sells the securities, lend to the Fed, lends out the new reserves, and those end up corresponding to deposits once those loans are made and spent. And now we have 1 million extra monetary base and 1 million extra in money supply. Okay? Any questions, comments? Okay, so this can't be the end of the story though, right? Because remember, we were discussing that the monetary base is going to end up being smaller than the money supply. Right now we have +1 monetary base, +1 money supply. So that can't be the end of the story. What happens? See what happens. Let's focus on this bank, which is the one where the reserves are now and where the new money supply is as well. So what's going on at this bank? This bank just got 1 million in new deposits. And again, in the instance in which they show up, it has 1 million in reserves. But remember, banks usually don't want to have reserves. They take funds that they receive, the liabilities, and they lend them out. Not all of them, right? They always have, again, some target reserve ratio. So let's just assume a number for that. Let's suppose the target reserve ratio is 10%. That's roughly the required reserve ratio in the United States right now. So if that's its target reserve ratio, this bank would like to lend out some of this, right? Not all of it. It still wants to keep 10% of that on its balance sheet as reserves. So what's 10% of 1? 10% of 1 is 0.1. And the rest they would like to lend out. Now, it might take time for them to do that, right? Because they have to find otherwise qualified people to lend to. But eventually, the bank would want to do this. And so say the bank lends 0.9 to, I don't know, let's say someone, let's write that again, someone from Georgetown who wants to buy a smaller yacht. You know, they can't afford the giant yacht that GW people can get. So what's going to happen then when this bank eventually gets around to finding an appropriate person to borrow? Well, now the money belongs to the whoever it is who sold them the boat. So the bank of the next boat seller, which may or may not be the same person, they have an extra 0.9 in deposits. And in the instant in which it shows up, we have 0.9 in reserves. So notice no reserves have been created. Here there was 1 million in reserves. When they eventually get to lend them out, there's 0.1 here and 0.9 here. So it's slowly spreading itself out like peanut butter across the banking system. There's still exactly only 1 million new reserves in total. So only the Fed can create new reserves. What's happened now with the money? We have this 1 million in money supply here. And now we have an extra plus 0.9 in deposits here. The money has multiplied. Why? Because when the banks get reserves, they lend them out. They're spent, deposited somewhere, and they correspond to an additional extra amount of reserves. And of course, notice that we're not done yet. This 0.9 is also excess reserves for this bank, at least, or rather, to be precise, undesired reserves. Excess reserves means reserves in excess of what is required. We mean it's more than what the bank desires, which may or may not equal required reserves. We'll go back to see that, whether they're different. What's important is that they don't want them. What they would like to do is, again, lend them out. All of them? No, just 10% of them. And sorry, just 90% of them. The rest of 10% they want to keep as reserves. So they would like to move to a situation where instead of having 0.9 in reserves, they had 10% of that, which is 0.09 reserves. And the rest they would have lent out. And again, it may take time for that to happen. But you should have sense now that, of course, those loans will also be spent and deposited somewhere. So we're not at the end of the process. And this cycle will continue on and on and on and on. And of course, each time the extra amount of money gets smaller, but it does converge. It's an infinite sum, but it does have a value, which we'll look at in a second. And excuse me. And this is ultimately the root of the multiplier. The root of the multiplier, this process that we're seeing, is the process of multiple deposit creation. So when the Fed creates some new reserves, those new reserves get lent out multiple times by the banks. Each time it's lent out, it creates another amount of deposits. And so that's how you can end up with this multiplier process. All right. Any questions, comments, doubts about this? The next thing is to see if this helps us understand how large or how small the multiplier is, and therefore what are the factors that might affect it. As discussed, anything that affects the multiplier may not necessarily be something that's under the Fed's control, which means that while the Fed exactly controls the monetary base, it may not have full control over what happens with it later on. So that's the next thing we want to look at. So let's wipe the slate clean. And recall, the money supply is the multiplier times the monetary base. What does our discussion suggest are the factors affecting the multiplier? Well, what did we see in the simple world where there's no currency? We saw that the banks take funds, and what makes the multiplier there is that they lend out most of them and only hold a piece of it in reserves. And since these funds keep getting lent and spent, it creates deposits multiple times. So one thing that affects the multiplier is, well, how much they're lending out, or conversely, how much they're keeping on their balance sheets as reserves. So there's multiple ways of putting that. One way is to say that the reserve ratio is a determinant of the strength of the multiplier. If the reserve ratio goes up, it means the banks are lending fewer funds, right? Each time they get new deposits, they don't lend out much of it. It's that lending that creates the multiplier, so a higher reserve ratio means the multiplier goes down. An alternative way of thinking about it is that the reserve ratio is basically the opposite of the bank's, let's call it lending intensity. The bank holding lots of reserves is the same thing as saying the bank is not lending that much. Now, remember, we're in this simple world where the monetary base is reserves, there's no currency. The money supply is what? Is deposits, there's no currency. We can actually figure out what's the relationship between these two. In other words, we can figure out what is the multiplier in this simple world. In this simple world, on each bank balance sheet, you have the deposits showing up on the left, the reserves showing up, on the right, the reserves showing up on the left. And on each balance sheet, we know that the reserves are smaller than the deposits, correct? So you could add up all the deposits in all the banks and all the reserves at all the banks, and you'd end up with a giant balance sheet where, again, the deposits are going to be larger than the reserves. If the deposits are X, some very large amount of dollars, the total deposits in the economy, what are the reserves going to be? It's going to be X times whatever reserve ratio the banks like. What is the multiplier? Rearranging this, divide both sides by a monetary base, you just get the multiplier is MB, the money supply over the monetary base, which is the deposits, which are X, divided by the reserves, which are X times the reserve ratio. Divide top and bottom by X, and what do we get? The multiplier is 1 over the reserve ratio. Again, reserve ratio up, multiplier down. Another way to compute the reserve ratio, remember we had this infinite sum of banks, getting deposits and lending them out, and then deposits show up somewhere else and they're lent out again. If you add up those infinite sums, that infinite sum of these numbers that are getting smaller each time a bank lends them out, you'll end up with the exact same formula, just so you know. But it would take time to do that, so I decided not to, especially since my power might suddenly go out and then I'll find myself talking to an empty, well, talking to a large black brick from Lenovo. Okay, so that's one factor. Remember, so far we've been looking at a simple world where there was no currency, and we came up with a very simple formula for the reserve ratio, right? Sorry, for the multiplier. What if we had currency? How would it change anything? Well, remember, currency isn't multiplied. Well, it might be multiplied if banks were holding currency as reserves, but it's not multiplied to the extent that you and I hold currency, right? Because if money is sitting in our pocket, it's not at the bank being lent out. So intuitively, putting currency into the mix here is going to also make the multiplier smaller. Now, how do we write that down? One way to write that down is, well, what's the importance of currency as a form of money? What's the alternative? Deposits. So why don't we measure this using currency over deposits and call that the currency ratio? It just means how important is currency as a form of money. If this goes up, so that for some reason there's more currency relative to deposits, again, intuitively, to the extent that you and I hold money, it's not getting multiplied, so the multiplier should go down. Then, of course, you might ask, is the currency ratio something that changes much? Why would the currency ratio change? Well, there are two reasons. One is slow. Think back 50 years. Okay, you weren't, nor was I. But 50 years ago, there were no ATM machines. At some point, about 40 years ago, I think. Actually, no, I think the first ATM machines started to show up about 50 years ago. But of course, there are very few of them. So it wasn't very convenient to use them. And so I remember when I was a kid, the first ATM machine showed up in Lima, Peru, where I was living. And there was one ATM, and it was outside the headquarters of Banco Continental. And I thought, what a stupid idea. Why would you want to get a card to use one machine in this whole vast city? So it wasn't very convenient to use electronic money back then, and so naturally the currency ratio was very high. But then as time went by, there are more ATM machines, it becomes more convenient to use electronic money, more stores start to accept it. And so people come to depend on electronic money more, and so the currency ratio would decline gradually. So what is this factor that's gradually reducing the currency ratio? Technical progress in payment systems. So that's always happening in the background. But could the currency ratio change suddenly? Could something happen that makes us, not gradually, but suddenly change whether we want to hold cash versus deposits? Well, you wouldn't want to give your money to someone else, whether it's a bank or anyone else, if you're not sure that it's going to come back. In other words, our willingness to hold deposits depends on our trust in the banking system. And of course, as discussed, that can change, right? There could be a banking crisis or a financial crisis that leads us to no longer trust the banks as much as we did. If that happens, the currency ratio might go up because we're all closing our accounts. The deposits are getting smaller. And then the multiplier might change. So to see that these aren't just theoretical ideas, but that they actually matter in real life, and that these things do sometimes change, and that when they change, the consequences can be dramatic. For that, I want to look at 3 banking crises, or financial crises rather, from US history. The Great Depression, the 2008 crisis, and, I'm sorry to say, now. And we'll look at them through the lens of what's happening to the monetary base, what's happening to the multiplier, and what's happening to the money supply. So here, you should see some figures. This is about the Great Depression. And you should see that there are 2 lines. This line here, the top one, is the money supply, measured using M1. This one is the monetary base. What do you notice about what these 2 things do over the period of the Great Depression? Well, money supply starts to decline and then declines steeply. What does the monetary base do? Nothing, right? It's pretty flat, except maybe for a blip here. In other words, the money supply must have been changing even though the Fed wasn't doing anything with the monetary base, which means the multiplier must have gone down. Why? Or 2, the currency ratio could have gone up because people lost trust in the banking system. Given that it says start of first banking crisis and end of final banking crisis here, that suggests that this was not a time in which people had much would have had much confidence in the banking system. But let's just look at those 2 factors to see what we see. This is too big. Excess reserve ratio. So this is reserves over and above what was required. The required reserves, well, they're not really changing, so it doesn't matter. Notice that in normal times, the excess reserve ratio, the reserves over and above what is required, is pretty small. Normally, the banks barely have excess reserves, but here suddenly in 1932, watch them shoot up, which is one of the things that could have explained the collapse in the money supply, right? Although notice it doesn't start until 1932. The money supply started going down before that. But still, remember there is a banking crisis. If banks are failing left and right, you might want to reassure your customers by having extra reserves. So it's reasonable to expect this. But again, it doesn't start until 1932, so something else must have been going on. Here is the currency ratio, the something else. As discussed, currency ratio tells you how much currency there is versus deposits. If it goes up, it means people don't trust the banking system. That's exactly what happens, and it started earlier, late 1930. So it looks like both of these things can change. They both change when there is a financial crisis. And in this case, it looks like it changed for people before it changed for banks. Like the people started closing their accounts and stuffing cash inside pillows before the banks reacted and started to try and boost their reserves. And through all of this, the Fed did nothing. Hardly, right? What happened? Well, intuitively, the money supply declined significantly over this period. And if something becomes scarce, usually it becomes more valuable. Money becoming more valuable means that it can buy more goods and services, which is the same thing as saying prices dropped. So in this period, there was deflation for years, extensive deflation. And as we discussed before, when there is deflation, it makes debts harder to pay in real terms, which makes the financial crisis worse. So aside from whatever happened that started the banking crisis, the Fed not doing much about it may not have helped. Their view was bad banks should just fail, and then the economy will just get back to where it was, to where it would have been. But again, as we were discussing last week, financial crises are much more complicated, and they're more like a downward spiral than just a bad day at the office or something. So along comes 2000. Here's all of that in one figure: the currency ratio and the excess reserve ratio. Fast forward to 2008. Here is the money supply going through the 80s, the 90s, the noughties, and here is 2008. The money supply grows steadily. Does anything unusual happen here in 2008? There's a blip, but it doesn't look, it's not a big blip. There's not a jump or anything like that, right? Money supply just keeps growing more or less as usual. In contrast, look at 2020. 2020, there's a clear departure, right, from the usual trend. It's the jump. So what's behind this? How come there was a financial crisis in 2008, but the money supply did not collapse? What must have happened? This is the monetary base. What happened? Blam. As soon as the crisis hit, the Fed just started buying bonds like crazy. So the multiplier is going down on one hand, but the Fed is pushing back by significantly increasing the monetary base. And so what do we see happen to the money supply? Nothing, because they were trying to do everything they could to avoid the deflation. They succeeded in a way, right? The money supply kept growing. There was a deflation, but it wasn't severe. But they keep buying bonds, just keep expanding the monetary base. And then here after, I don't know, 2015, they sort of start to try and get back down. But then 2020 comes along and poof, off the charts again with monetary base. If you look at here, it's under $1 trillion. Up here, it's 4 trillion. It came down close to 3, and then now it's jumped to $5.5 trillion. Look at that jump. It's like 8 times what it used to be. What else is going on under the hood? Remember we looked at excess reserves before? Here are the excess reserves again. As I was saying, notice in normal times, excess reserves are very small. Because they're, well, remember back then, 2 things. It's costly to hold excess reserves because they're funds that you aren't borrowing. Sorry, that you aren't lending to anyone. Then we hit 2008 and whew, again, off the charts. Banks are holding tons and tons of reserves. And then the extra reserves, excess reserves. Then it comes down, and then 2020 comes along, and again, we're off the charts. This figure tells us a lot. This figure tells us, first of all, that since 2008, we've been in, at least in some sense, the banking system has been in Great Depression-like conditions, holding all these excess reserves, which they wouldn't in normal times. It also suggests that central banking, if we go up here, the way central banking is conducted changed after 2008. And so the theories that we use to understand how monetary policy might have worked back here might be different from what we need to think about how monetary policy has worked since 2008. To be precise, we'll have a theory and we'll be able to accommodate both. But one question, do you remember the one thing that exists now, the one tool of monetary policy that exists now that did not exist prior to 2008? I've mentioned this at some point in the past. The interest rate on reserves. Prior to 2008, you did not get any interest on reserves. After 2008, if you're a bank, you could get interest on your reserves at the Fed. So we know that something changed in the world of central banking since then. And so it turns out the interest rate paid on reserves is going to play a key role in our theory of how monetary policy works. Okay? Keep that in mind. Hold that thought for later. Here are the excess reserves. Remember, now they're not costly to hold because the Fed is paying interest on them. And again, it looks like they were trying to exit from whatever they were doing in 2008, but then along came 2020, and we're stuck again. So, what have we covered so far? Several things. One was that we've discussed how monetary base turns into money supply, which is sort of like looking under the hood of the multiplier. Second, we saw that there are two factors affecting the multiplier that are apparent when you go through that process, looking under the hood of the multiplier. One is the reserve ratio. And the other is the currency ratio, which is sort of a proxy for lack of trust in the banking system, at least at short notice. In the case when there's no currency, there's a very simple expression of the multiplier. In the case where there is currency, if you look at the textbook, you'll see that they do actually have a multiplier formula. But it's complicated because it depends, well, first of all, you just introduced currency, and second, there's a question of how much currency ends up on the balance sheet of banks, because that currency might get multiplied. So it's a complicated formula. You don't need to memorize it. The key points are to remember what are the factors that affect the multiplier, which thus the Fed needs to take into account when deciding how much monetary base it's going to make. As we saw in the case of the Depression, the multiplier collapsed due to both of these factors, which led the money supply to decrease, leading to deflation. In the case of 2008, and now actually, the multiplier went down because the reserve ratio went up, but the Fed pushed back by decreasing the monetary base, so the money supply didn't do much. Interestingly, in the case of 2020 and nowadays, the increase in the monetary base was so significant that we actually saw the money supply go up. Did they overdo it? I don't know. We'll find out. The hard way. Any questions, comments, doubts? If not, there's one last thing I want to put on your radar before we go to the exit quiz, which is the following. Remember that all these reserves that we're talking about, we've seen that the banks are buying and selling securities to each other, or to the Fed sometimes, to try and get reserves. The banks are also borrowing and lending to each other on the borrowing side, these overnight loans we discussed. There's just a fixed number of reserves, right? The Fed decides how many reserves it wants, and then they give them to the banks. So the Fed creates reserves, and gives it to the banks. And then what the banks do is they borrow and lend these reserves back and forth to each other. As they feel it's needed. Someone wrote, an increase in excess reserves decreases the multiplier. Yes, an increase in any in reserves. Right, Marshall answered, because reserve ratio goes up, correct. So the Fed creates these reserves, the banks hold on to them and lend needed. And this makes it sound almost as if there is basically a market for reserves where we have the Fed as the entity that is on the supply side, and the banks, for various reasons, are there on the demand side, right? That's kind of the picture that's being painted here. The Fed puts out a bunch of reserves that the banks might want, then the banks pass it back and forth to each other by borrowing, lending, buying, selling securities, and so on. And our theory for trying to understand how monetary policy works is going to be exactly this market. So that's our job for Wednesday. However, as I mentioned, I wanted to put something on your radar before that, because when we put together a puzzle, sometimes it's good to know, first of all, what are the elements, what are the pieces of that puzzle that we need to put together. So I wanted to discuss what are the pieces, so that then when we come to class on Wednesday, we've already had a little time to digest them, and so some of the pieces are already familiar. So let's draw a demand-supply figure and try and think about what we would think intuitively should be on it. On the x-axis, we always put the good that we're the good that we're discussing. What's the good or service? In this case, it's the market for reserves. So that should be reserves in dollars or trillions of dollars. The vertical axis, in other words, if you are a bank and you demand some reserves from another bank, what do you have to pay them? In other words, what's the cost of getting the marginal cost of getting reserves from someone else? Persuading a bank to give up one of their reserves and lend them to you? Well, it's the interest rate that banks charge each other, which is, of course, our old friend, the federal funds rate. So we can think of the interbank market for reserves in demand and supply terms with the federal funds rate as the price or opportunity cost of reserves. If you want reserves, that's what you have to pay. If you have reserves, that's what you're giving up. And now let's look at the supply and demand. Let's just draw a demand curve, downward sloping, as usual, because of course the less of it you would demand, and the banks are all here, demanding reserves for various purposes. What about the supply? Well, the supply is entirely dictated by the Fed, right? So the supply is just some number that the Fed chooses. And so what does this suggest? It suggests that the Fed can pretty much, as long as it knows what the demand curve it looks like, they can basically pick the Fed funds rate that they want. And that's how monetary policy is often discussed in terms of the Fed's target Fed funds rate. How could they have a target? It's because they control the supply side in the interbank market for liquids. So this is a simple first pass at trying to think about how the market for reserves works. However, there are two more elements that are going to make this complicated, or more complicated. One is that there is a ceiling on the federal funds rate. There's a rate that it can't go above. How come? Well, the banks are borrowing and lending to each other in this federal funds market. What about if, what is the alternative? If you're a bank and you want to borrow some reserves, you could go and borrow it from another bank, but you could also go and borrow it from the Fed. And you're not going to borrow from other banks if they're charging you more than the Fed. So what's the ceiling on the federal funds rates? It's the discount rates. Similarly, there is a floor on the federal funds rate. And what is that? Well, now suppose you were one of the banks that brings funds to the federal funds market. You're thinking of lending to someone in this market. You have an alternative. Instead of lending funds to other banks, if you have some excess reserves or undesired reserves, you could just leave them as reserves. And if you leave them as reserves, what do you get paid? The interest rate on reserves. And you would never bring funds to the federal funds market to lend if the interest rate were lower. So the floor on the federal funds rate is the interest rate on reserves. So while it doesn't take too long to construct this picture, which tells us the Fed can probably has pretty good control of the Fed funds rate, at least in normal times, it's complicated by the fact that there is this price ceiling and price floor. So when we come and look at this again on Wednesday, we'll need to figure out how to represent this price ceiling and this price floor in this picture. Okay? So that's teeing up our discussion for next Wednesday. Any questions, comments, thoughts, doubts, or anything else you want to share? If not, then it's time for our exit quiz. Let's go. True or false? A decrease in trust in the banking system lowers the money supply. That's right, because people start to withdraw their funds, so fewer money gets multiplied, and so the money supply goes down. Next. True or false? A decrease in the reserve ratio lowers the money supply. What do you think? It is false. A decrease in reserve ratio means banks are lending more intensely, so it increases the money supply. Very good. Next. Who controls the supply of reserves? Is it the central bank, large banks, the FDIC, or the Treasury? It is the central bank. Very good. This is a new type of question where you have to type it out. What is the name of the interest rate the Fed charges on loans that it makes? Now, when you type this out, make sure to write your answer as 2 words. So if the answer is reserve ratio, don't write the reserve ratio, just write reserve ratio. And tell me what you think of this type of question later. Seems to be taking a while to type. This is awfully creepy music. I never felt this way about interest rate, about Fed loans. The answer was the discount rates. Remember, it's the name of the interest rates. All right, next. What is the floor on the federal funds rates? It is the interest rate on reserves. Very good. And finally, what is the ceiling on the federal funds rates? It is indeed the discount rates. Very good. Let's see how we did. Third place, we have Sophia. Very good. Second place, we have Alexandra C. Very good. And in first place today, we have Marshall. All right. So, Marshall, what Snapchat filter should I look for?
Can you find something like a kitty cat?
Yeah, I can put a cat on my head.
That's perfect.
Okay, very good.
Thank you very much.
All right. I don't know how they programmed this. I'm impressed. All right. Thanks, everyone. Stay in touch. Tell me if you wish to discuss anything. You can book a slot in office hours. If not, we'll see you on Wednesday. Take care.